Hello and welcome to Project Trade. This is the Technical Indicators show. And in this video, we're looking at the exponential moving average. We're going to give credit to 3 people for the exponential moving average. And in the beginning, there was Robert Brown, a member of the US Navy during World War II, who implemented a system of using exponential smoothing to help track the location of submarines. He later used that same methodology after the war in relation to managing spare parts inventory, which he discusses in his 1959 book, Statistical Forecasting for Inventory Control. Meanwhile, in 1957, Charles Holt released his influential paper called Forecasting Seasonals and Trends by Exponentially Weighted Moving Averages. It was an incredibly fun read which drew a lot more attention to this methodology of moving averages. And finally, in 1968, former rocket scientist Pete Horlin became the first person to slap the exponential moving average onto a stock chart. At the time, he called them trend values, and he called the smoothing of this data the proportional control. Now, the exponential moving average is in heavy competition when it comes to other moving averages. What you need to know is that when it comes to measuring the value of the price, the exponential moving average treats the most recent data as the most relevant. It attempts to find out what the trend has been so that you can try and figure out what the future trend will be, which will then inevitably lead you into a saturated bank account. The main input you'll probably be working with for the EMA is the number of periods. Whether you want something quick looking back at say 5 periods or something long term up at 200 periods, that's up to you. If your strategy works with just one moving average or with 4 different averages, that's fine. But just think about why you're using them and how they add to your winning trades or reduce your number of losing trades, because either way is beneficial to you, the trader. A few examples here of what the EMA looks like on the chart with a mix of inputs. We've got a 20 period there, an 80 period and a 200. The steeper those lines go and the further they move from one another, the faster that price is moving in a trending direction. When they start to flatten, it can be a signal that price movement is slowing down and the trend will either finish or reverse. If you think you'll need a whole big group of exponential moving averages to guide your path, you can always treat yourself to a guppy multiple moving average, which uses 2 sets of EMAs split into shorter and longer sets of 6. But let's move past exotic adaptations of common indicators and find out what's driving our EMA. If we're going from scratch, then the formula is a 3-step process. Step 1 is to understand the simple moving average formula. For anyone unsure, we're just adding together the total price for the number of periods we've input and then dividing that total by the number of periods. It gives us an arithmetic mean average. Then step 2 is understanding the weighting of the exponential moving average, which is known as our multiplier, marked as K in this formula. So to get K, you take the number of periods you're looking back at and add 1 to that number, then do 2 divided by that figure. For example, if you're looking back at 14 periods, you would do 2 divided by 15 for a K multiplier of 0.133. Now we understand those parts, we can jump onto the formula for the EMA, which you can see here. We take today's price and subtract yesterday's EMA figure, and then we multiply that by the multiplier that you had from the K formula, and then add on yesterday's EMA. I have seen this formula expressed through different methodologies and how they arrange the key elements of the formula, but they do give identical answers, so it's the same ends but with different means. This is just the particular formula that I've chosen to demonstrate it through. Let's take it to an example because it may seem confusing at the moment. Let's resolve that. We're going to calculate a 10-period exponential moving average. We'll say there's no prior EMA, so we will have to first wait for 10 periods to pass to get a simple moving average. That's our step 1. Our stock price in these first 10 periods has been trading between $10 and $15 in a clear uptrend as we go from the oldest period on the left to the newest period on the right. We can add together the prices from those first 10 periods, which totals 119, and divide them by 10 periods, giving us a simple moving average of $11.9. For step 2, we can work out our multiplier. Since we're going for a 10-period average, we would compute 2 divided by 11, which rounds off to 0.18. So then at step 3, our EMA gets kicked off. It's the 11th period and the price is $16, so we take the 16 and subtract the SMA of 11.9 from the first 10 periods for 4.1. We times that by our multiplier of 0.18, and then add on the simple moving average. That gives us 12.64. And so for all the future periods, we no longer need the simple moving average because we'll have our previous exponential moving average, as you can see demonstrated in the table. With our exponential average figures, we've also added a comparison to the simple moving average on the right hand side, and we can see as the stock's price continues to climb, the EMA does get a whisker out in front of the SMA. Of course, they're both only 10 periods though, so we wouldn't expect them to drift too far from one another. It probably does look quite clunky with so many figures on the page, but hopefully that does make sense. But just because the EMA responds quicker than the SMA, does that make it a superior indicator? The simple average is the original, it's the easiest to understand, and it also is the easiest to calculate if you like to go old school and hand draw your indicators on the chart as you go. And I would recommend a safe and stable 2B pencil if you are doing that. But the exponential average is the answer to the missed opportunities that can come from the simple average, as the exponential will respond faster to a sudden price movement, and sometimes that can be the difference maker as to whether you get profits or not. In this example, we've got a 30-period simple moving average and a 30-period exponential moving average. It's clear that the exponential responds quicker, and depending how you're utilizing them, there could be an impact of using one or the other. If you are purely going on the slope, being upward or downward as your entry signal, well then the brown EMA would catch that big candle right there for a better chance of profits, where the simple moving average would actually miss a chunk of it. Same on the other side as well, the EMA catches a little more of the early move compared to when the SMA turns up. If you were using the price crossing the average as your signal in this example, then there wouldn't be any difference, as in both instances of price crossing the averages, they do occur at the exact same time. The point is to just be careful what signals you're using for the averages and which average is the best for each signal. Those small differences can go a long way over time. The EMA's quicker response time is also going to give you an increase of false signal. It's where price just ends up being in a range or a whipsaw or a retracement. This is still very much a lagging indicator no matter how quickly it tries to respond. At the end of the day, both the exponential and simple averages are very popular, and both are used as analytical tools in numerous strategies, as well as being used in other indicators. For example, the Bollinger Bands indicator would typically use a simple moving average, whereas the Keltner channel would incorporate an exponential average. So much like the difference between Bollinger and Keltner, the choice is up to you, and you may not use either. There's many more available averages, and they're all trying to do the same thing. With the exponential moving average, like all the other standard moving averages, you're going to get given a range of options on your platform for which part of the price you want to use for the moving average formula. I often stick with the close price and tend to avoid the highs or lows due to their inconsistency and price anomalies, but it's your decision. And the final input that your platform should give you is whether you want to shift the indicator forward or not. In this example, the deep sky blue average is set to appear 10 periods later than the zero shift Peru colored average. It's just another option that you might be able to incorporate into a moving average strategy. But here's the typical entry signals you can get from the exponential moving average. Strategy-wise though, they're not going to differ from the simple moving average or any of the moving averages that don't have extra bells and whistles. So firstly, you've got the moving average sloping up or down. So you could say that if the exponential average starts to slope up, then you would enter a buy trade. And when it slopes down, you would enter a sell trade. In case anyone is unclear on what we mean by up or down, I have marked them on the chart here for your benefit, so feel free to pause the video for as long as you might need. Next up, we've got when the price actually closes above or below the moving average. So you'd say that when the price closed above the average, you'd enter into a buy trade, and when it closed below, you would enter a sell trade. Or you can say that if the price doesn't close across the average, but instead it bounces off it, well, you could take a trade in the direction of where the price is bouncing towards. You can see here where it could act as a good re-entry signal to a trend if you want to get back in or if you felt you missed a part of it. And the final entry signal to take directly from the exponential average is plugging it into a moving average crossover strategy. Here's using the 30 and the 90 period moving averages, and we can see that when the faster 30 period average crosses over that slow 90 period, we would enter either a buy or sell trade. It's that basic, which is often a bad sign in trading. And if you are using any of these entry signals, make sure you try and let the candle close before you enter. Sometimes you'll see that high or low in price happen that makes it look like the indicator is going to give you that entry signal, and you want to get in just a little bit ahead of the indicator. This is a bad move, and you will lack consistency in the application of a strategy. Instead of following set rules, you're going on gut instinct if you feel the indicator will go in your favor, but it can easily turn at the last second, and that suddenly puts a lot of pressure on your personal judgment, which is exactly what can lead to frustration, that leads to making rash trades and breaking more rules from your system. These moving average signals are already incredibly mediocre, so why make it more difficult on yourself? Hence why a lot of traders won't actually take their entry signals to the moving average, but they'll use it as a filter for other indicators they're looking at. So you would say, hey, if price is above the moving average, I'm only going to take buy trades from my other indicators, and if price is below the moving average, I'm only going to take sell trades from those indicators. That's how the moving average sneaks its way into a lot of traders' strategies and why it makes it so popular. But don't take your needle off the gramophone just yet. We are going to move towards how this moving average can help you with your money management. To start with, we can use those entry signals that we just talked about and reverse them into exit signals. There's 3 of them there, so let's just use a couple for examples. If you're in a buy trade, then you could say that if the moving average starts sloping downward or if price closed under the average, then that's when you'd exit the trade to either save your profits or cut your losses. I mean, you could use these signals for both entry and exit signals. Why not? Who needs anything more than a couple moving averages just to make millions? If you're struggling with that, you could also try and use the exponential average as a trailing stop. Always a useful tool, the trailing stop, to help you try and maximize the profits you're getting from a trade, particularly when you're in a long trend. Using the trailing stop loss with the exponential average, you'd place it just below the moving average and then you'd move it in the direction of your trade if it goes in your favor, but never back from there. That's the basic money management tools from the indicator in a nutshell. You can find uses for the exponential average in all markets, though different things are going to work on different assets, but Forex, stocks, commodities, moving averages have a lot of versatile applications that can fit into a lot of different strategies. Just keep track of what's going on in the market if you're using the exponential average. Moving averages in general can get thrown off by anomalies caused by a brief period of high volatility due to any number of factors such as the release of economic numbers like the PPI or retail sales, things like the stock market open, analysts putting out reports on stocks, upgrading them or downgrading them. Even things like tweets can have a major impact on an asset's price. So whilst it's difficult to track all of these and you can't be prepared for everything without illegally having inside information, it is important to understand the impact that these things have on a moving average, particularly the exponential average, which tries to respond quickly to the information. And in every market, no matter what every permeable might think, there's always that range, and these trend-presuming moving averages can walk straight into the crocodile's mouth. Look at some of these entries if we were using the moving average crossover as our signals. So we're entering when that 10-period aqua line crosses over the 45-period darker blue line. We've got a buy trade up to begin with. Unless you are the wizard of taking profits at the peak, then I'm sure it's going to be a bust like it would be for the rest of us. Leading us onto this sell trade next, and the actual cross there, it's going to come pretty close to the very bottom of the market before taking off again and getting you right back into a buy trade after that large green candle. I mean, we can look at this and convince ourselves that obviously we would get in at the bottom of that candle and catch the run, but this is probably a lie, which is just going to lead you into future losses. Moving on, we've got more losses from this sell trade. You're not going to get any profits out of it. The only way you're winning is if it's opposite day and you're taking the reverse signals, which can be a strategy if you can time the range correctly. Equally as difficult as trying to find the trend. We've got another buy trade there just before we get into a sell trade again. This is not good. These trades are all going to be losses if you are chasing the trend. If you made some good money previously on an everlasting trend, that is all gone now, just within this range. Your psychology is going to be rattled and you'll probably miss the next trend out of pure frustration caused by a frustrating system. It's just a fair warning of a lagging trend indicator in a range. If you're not satisfied with the results, there are plenty of other moving averages out there. You want a moving average but don't like the exponential methodology? Grab that simple moving average or the linear weighted. You got Holes, you got Kaufman's. You already know there's many more that are out there. If you want an alternative methodology, you can find something like that within the Ichimoku indicator. You've got the Tenkan-Sen and the KIJUN-SEN lines. They perform the same function as a moving average does, but instead they look back at a number of periods. They take the highest high and the lowest low from those periods, add them together and divide it by 2, and then connect those plot lines on the chart in the same fashion as you would a moving average. As a quick example here, I've stripped back the entire Ichimoku indicator to just the KIJUN-SEN line, and I've made it 50 periods. It's adding together the highest high and the lowest low from the last 50 periods and dividing that total by 2. It's going to be a useful tool to try and replacement of a moving average, as you can take the same signals from it. And just to wrap it one more time, if you do want a whole mess of exponential moving averages, consider the guppy. In conclusion, the EMA is a logical alternative to the simple moving average. When you use the simple average and you get into trends later than you'd like to, you're desperate for something that weighs the recent data as more relevant, and this is a fair solution to that problem. The counter issue to that being that you'll get more false signals than you would with the slower moving averages, and this is going to lead you to an increase in losing trades and being stopped out. But nevertheless, the exponential average is a versatile tool with possible entry signals, exit signals, money management, built-in strategies and tools for filtering out bad trades. It's a real jack of all. At the end of the day though, it's still a moving average and not a miracle. You can't expect something like this to do all the heavy work in your strategies. It's much more likely to be an assisting indicator that keeps you out of bad trades, which is still a great thing. If the EMA saves you from a losing trade, then it's saved your money for another trade, which is really going to start to add up over time. So if you are going to use it in conjunction with other indicators, give the various signals that the moving averages give you a go, and try it in every which way. You might find something that no one ever has. Unlikely, but who knows? There's a lot of options out there. There is more information and links in the description if you are interested in going for an even deeper dive down into the Marianas Trench that is the EMA. And do not forget that every chart and image I show you has been completely pre-selected for demonstrating how the indicator may or may not work. Consider them a mirage from profit dehydration, if you will. But I have used this indicator in live forward testing strategies and will also link those in the description. This is Project Trade. I am Darth Trader, and thank you for watching.